Hello and welcome back to my channel. My name is Mohammed Zishan. I'm a UK-based tax accountant and tax advisor. I've been advising clients for past 6-7 years now. So in this video, I'm going to walk you through one of the most important tax topic for overseas investors, and which is the UK tax rules for non-resident landlords. If you live abroad and own or plan to buy a property in the UK, you need to understand how income tax, capital gain tax, SDLT, and other rules apply to you. Whether you are an expat or an overseas investor with buy to let property portfolios, this video will help you to navigate UK tax landscape and avoid expensive mistakes. So let's start with the basic. What is a non-resident landlord? Or you can rephrase it and say, who is a non-resident landlord? A non-resident landlord is anyone who receives rental income from the UK property but lives outside the UK, and following statutory resident test meets conditions of automatic overseas test. When it comes to the UK property, it does not matter whether you are resident or non-resident. HMRC still requires you to report and pay tax on your UK rental profits. This also applies to companies and trusts that are based overseas but own UK property. Now that we have understood who qualifies for non-resident landlord, now take a closer look how rental income taxed. Non-resident landlords are individuals to UK income tax on the profits they make from renting out property in the UK. The rental profit is calculated as your total rental income minus allowable expenses such as letting agent fees, maintenance and repair cost, insurance and restricted mortgage interest relief. The tax is charged at the same rates as for UK residents, which is 20%, 40% or 45% depending on your total UK income. But non-residents do not automatically get a personal allowance unless they qualify under a double tax treaty, and you must report your rental income to HMRC through self-assessment. And please do not forget to filing deadline is 31st January 2026. And if you need any help around this, please don't hesitate to reach out. But here is the catch: most landlords do not get paid full rent upfront. So let's discuss why this happened. Under the non-resident landlord schemes, UK letting agents are legally required to deduct basic rate tax, currently 20% from your rental income before paying it to you. This is to ensure that HMRC receives at least some tax in advance, even before your self-assessment is filed. However, you can apply to HMRC to receive your rental income gross by submitting an non-resident landlord 1 form, or which is sometimes called as N or L1 form for individuals or N or L2 form for companies. Once approved, your agent can stop deducting tax and pay you the full rent. But remember, being approved for gross payment does not remove your duty to file a tax return and pay any additional tax owed. Now, let's step outside the tax and discuss a practical or address the practical concerns which most landlords overlook, and which is council tax. Council tax is a charge imposed by local council on residential properties. If your property is rented, usually tenants are responsible for paying the council tax. However, if the property is vacant, you as a landlord is responsible for council tax. If you are a non-resident landlord, it's easy to assume this is not your concern, but unpaid council tax can lead to enforcement action against you. Always check with the local authority in the properties areas to avoid unexpected liabilities. Now that we have discussed most of the areas for UK rental properties, now have a look on what happens when you sell a UK property. When you sell UK property, any gain you make is subject to UK capital gain tax, even if you are not UK resident. Since April 2015, non-residents have been liable to CGT on UK residential property, and since since April 2019, this has extended to commercial property and even indirect disposals, such as shares in property-rich companies. You are required to report the sale and pay any CGT within 60 days of completion. The gain is calculated using a rebased value as of April 2015 or April 2019, depending on the type of asset. Rates vary: 18% or 24% for residential gains and 10% or 20% for commercial property or shares, depending on your income level. One important thing to remember is that if you are a non-resident and you sell a property which is loss making, you still need to report that to HMRC. Of course, before you reach to this level, you have already paid another tax, which is stamp duty land tax. Now quickly cover that. Stamp duty is payable when you purchase property in England or Northern Ireland, and non-resident face additional charges. Since April 2021, a 2% non-resident surcharge applies to on top of the standard SDLT rates. If the purchase is a second property or an investment property, an additional 5% surcharge also applies. It's always a good idea to consult specialists and check if you qualify for any relief. And if you are investing in properties through your limited company, then the tax landscape will change. Now, let's look into a corporation tax side. Since April 2020, non-registered companies that earn rental income from UK properties are taxed under the UK corporation tax regime. The current main rate is 25% through margin relief may apply to small companies. One key advantage for companies is that they can deduct full finance costs, including mortgage interest, which individuals landlord can no longer fully claim. These companies must register with HMRC, file annual accounts and corporation tax return. Corporate route can be more tax efficient in some cases, but it also involves higher compliance obligations. Now, owning a property through a company brings us to another tax, which is ATID, annual tax on enveloped dwellings. ATID is a yearly tax that applies when a company owns a UK residential properties valued at more than £500,000. The tax is calculated based on the property's market value, and annual charges can range from around £4,400 to over £269,000. However, if the property is let out on commercial basis or used for development or trading, you can claim relief, but you must still file an ATID return to claim it. This return must be submitted by 30 April each year, even if no tax is due. Many non-resident investors miss this requirement and face late filing penalties. If you are considering holding UK property in a company, make sure to assess whether ATID will apply and plan accordingly. Next, let's talk about a long-term tax considerations that often overlooked, which is inheritance tax. UK property owned by non-resident is fully within the scope of UK inheritance tax. The basic nil rate band is £325,000 since 2017. Even properties held through offshore companies are no longer shielded from IST. There are reliefs available which you can consult with state planning expert to protect your wealth for the next generation. Before we wrap it up, let's look into double tax treaties. Many non-resident landlords face the issue of being taxed in both the UK and their country of residence. The UK has signed numerous double tax treaties that help avoid this situation by allowing relief through foreign tax credits or exemptions methods. To benefit, you may need to provide a certificate of tax residency from your local tax authority. However, these treaties vary from country to country, so what applies in Pakistan might not apply in Canada or South Africa. Coordinating with advisors in both jurisdictions is essential to avoid double taxations. As you have seen, UK tax is quite complex for non-resident landlords, covering income tax, CGT, stamp duty land tax, corporation tax, and all of these taxes have their own reporting requirements and reliefs. And understanding any one UK tax at the time is not sufficient enough. You need to understand how one tax correlates to another tax, and getting a tailored advice might help you to understand it. And if you found this video helpful, please do not shy to share it with your colleagues and friends. As always, hand ahead, salute, until the next video.